Ladies and gentlemen, Greg McCloskey from ForexLive.com. If you watch my videos and read my posts on ForexLive.com, I love the 100 and 200 bar moving averages. Why do I love those moving averages? Because I truly believe that traders around the world, that's you, look at that moving average and make trading decisions against those moving averages. I will say the smart traders do that because risk can be defined and risk can be limited against that moving average. And if you learn to risk a little to make more than a little, that's what a successful trader is about. So if you believe that those moving averages provide or have a lot of traders looking at them, those traders are going to lean against those moving averages. And when you lean against a moving average, you get a movement either away or through that moving average. And that is a key piece of information for all traders around the world who are focused on risk, and that should be you. So let me show you what I mean and explain what I mean in this video. All right, we know that the yen crosses all moved to the downside in trading this week. Why? Because the Nikkei fell by minus 12.4% on Monday, and that sent all the yen crosses to the downside. The idea was that the carry trade was being liquidated. So if the carry trade is being liquidated, what did that sharp move to the downside in those yen crosses do to the technicals? And so I want to take a longer view of the weekly chart to see what this sharp move from the highs in July did to the longer term trade. And if you take a look at the sterling versus yen, what we do know is that the price has been trending to the upside. This is the carry trade. Traders were borrowing yen and kept on borrowing, forcing the pound versus yen to the upside. And then things start to unwind. And when things start to unwind, that means the carry trade is unwinding. You get a sharp move to the downside. But as you can see, the move to the downside did have a limit, and that limit was near the 100-week moving average, a blue line in this chart. The price came down to that level, found support buyers on Monday, and was able to bounce to the upside. Now let's take a look at another currency pair like the euro yen, and this on the weekly chart has the same pattern with the sharp move to the upside from the 2020-2019 low all the way to the high price that we saw in July. In this case, we fell sharply, and where do we find support buyers? Right against the 100-week moving average. What about the Aussie versus yen? And here, if we take a look at the weekly chart of this currency pair, we get the same pattern with a sharp move from the 2020 low to the high price that we saw in July. And the move to the downside for this currency pair got below the 100-week moving average, which bottomed the pair last week. And in trading this week, we move right down, and where do we stall? Right against a 200-week moving average. Is it a surprise for me that all these moves sharply to the downside stalled against either the 100-week moving average or the 200-week moving average? No. Why? Because if traders were to buy against that 200-week moving average, they might look to put a stop, let's just say right here, in which case they're risking what? This amount on the trade for the hope that they make more than that on the rebound to the upside. And what happened? Well, the price on Tuesday and Wednesday moved higher, and we moved all the way back up to the 100-week moving average up here. And so we risked this much to possibly make that much on a 2-day rally to the upside. That's a good risk-reward return, isn't it? On the sterling versus yen, if you take a look at the weekly chart, people who bought against the 100-week moving average may have even put their stop down here at the 38.2% retracement of that same move to the upside. In this case, they're risking even more on the trade, but what they're hoping is they make more than that on the trade. Indeed, the price did move above that level, and where do we go? We went right up to this swing area right through here and are finding willing sellers against that level, at least for now, against that level. So risking this much, making more than that much on the trade. So that's why traders lean against moving averages, because lots of traders look at it. Lots of traders can define risk and limit risk against that level, and as the level holds, then they stand to make on the rebound back to the upside. Otherwise, if the price goes through that level, they get out of the trade or even go short on the break of the 100-week moving average. That may be a trade for traders to do as well. Now, if we, as most people know on ForexLive.com, I also like to use the same moving averages on other time frames. For instance, I might take a look at the euro versus yen, and I see that the price in this currency pair fell below both the 100 and 200-week hour moving averages right here. That tilts the bias more to the downside. When the price comes back up to the 100-hour moving average, what do? We find sellers. When the price comes back to the 100-hour moving average, what do? We find sellers, we find sellers, we find sellers, we find sellers, we find sellers. In this case, when the price finally moved above the 100-hour moving average, what do? We came up and found sellers against the 100-day moving average right here and rotated the downside. When we fell back below that level, what do? We found sellers against the 100-hour moving average once again. In trading here today, what did? We moved above the 100-hour moving average. And what was the last thing we did on this corrective move to the downside? Find buyers against the 100-hour moving average. Next target on the top side comes against a 200-hour moving average. So you see, it doesn't matter which chart you're looking at. In my mind, lots of traders around the world are using these 100 and 200 bar moving averages for levels to define risk, limit risk, and accept risk, and a way to risk a little to make more than a little. That's what you should be doing as well. That's why these moving averages are so important. As long as the market reacts to those moving averages and they prove it time and time again, all you have to do is watch my posts on forexlive.com. You'll see it, and you'll start to benefit more in your trading. My name is Greg Michalowski. I hope you liked this video. If you did, give it a thumbs up. If you didn't like it, give it a thumbs down. And if you have any comments, please feel free to put them on the video as well. Good fortune with your trading. Bye-bye now.